Hey everyone, welcome back to Corporate Decoder. Today we're diving into Bank7 Corp's latest 10K filing, their annual report. Get ready because this report has more twists than a bank heist movie. We're going to decode if this bank is building a financial fortress or teetering on a tightrope. First, let's get a quick snapshot. Bank7 is based in Oklahoma City, operating 12 branches across Oklahoma, Texas, and Kansas. They're all about serving business owners and entrepreneurs, promising fast and consistent banking solutions. As of the end of 2024, they're sitting on $1.74 billion in assets. So what services are we talking about? They offer everything from commercial and retail deposit accounts to various lending options, including commercial real estate, hospitality, energy, and general commercial loans. They also dabble in smaller consumer loans. Their bread and butter is developing strong relationships with their commercial clients and their main people. Now, let's see if they're painting a rosy picture or facing some stormy weather by taking a peek at some numbers. We can see what's up with their business by looking at their financial tables. So let's scroll to it. All right, let's talk money. Their net interest income, that's the profit from loans versus deposits, increased to $86.19 million, like a good thing. But their net interest margin, which is the percentage they earn on those assets, is 5.11%. We can see that it has also improved a tiny bit from last year when it was 4.97%. It looks like their lending strategy, at least at the moment, is working ML even with 4.97%. It looks like their lending strategy, at least at the moment, is working. Even though you always want to see these numbers growing at a faster pace, let's see if that trend is sustainable. It's worth noting that comparing 2024 to 2023, net interest income has grown by only 3.6 million. But when we compare 2023 to 2022, net interest income grew by 13.1 million. That's a red flag. That shows that tailwinds in prior years have stagnated in the present. Keep in mind that while the bank can make smart decisions, it can't control market interest rates. We need to watch for this and see whether management can address this, and it can't control market interest rates. We need to watch for this and see whether management can address this. Now, let's look at where their loans are allocated. As of the end of 2024, their commercial real estate portfolio is more than half of their total loans. These are followed by commercial and industrial loans and agricultural loans. Speaking of loans, this could be a big problem. It says here that the top 20 borrowing relationships make up roughly 33% of all their outstanding loan commitments. That is quite a high number, and if a few of these relationships were to run into trouble, it could cause major damage to the bank's health. On the income side, non-interest income is up, which is good, rising from $9.2 million, mostly because of the oil and gas assets they've acquired. That shows that the management is thinking outside the box and trying to diversify income. Okay, now let's look at the other side of the coin, which is how much it costs to run the place. Well, salaries and benefits went up over almost 20% from 1720s to 27 million. You have to wonder here whether that was worth it or whether the employees are contributing to increased profit. Now let's talk about the less thrilling but super important part, risks. We see here they're exposed to the risk that hackers can get into their systems and steal customer data. Because financial institutions are a big and juicy target, we can see if and how the business is protecting against that. Alright, the security risk is real, but it seems like the company isn't sitting still. They basically outsource their IT security to a third party, bank on IT, and that they also engage in regular third-party security checks and employee training. It is good to see that they're on top of security as so much fraud happens these days. It's also good to know that they haven't had a major cyber incident to date, and hopefully they keep it that way. Another big risk is location. Most of their loans are in Oklahoma, Texas, and Kansas. So any downturn in those markets is a big deal for them, much more so than if their loans were spread all across the United States. If you want to get even more specific, the company has exposure to the energy industry as well, so that's something we want to keep our eye on. This is a big one. As part of their regulatory oversight, the federal regulators look at the financial institutions' commercial real estate loans. If the regulators are concerned about their commercial real estate loan concentrations, it could limit their ability to grow by restricting their approvals for branches and mergers. It could also force them to raise additional capital. Alright, let's move on. The company's ability to pay dividends or repurchase stock is affected by the regulations and policies of the Federal Reserve. That's something to keep in mind. Now for the shareholders. The biggest shareholders can decide to dump a bunch of stock into the market, which can make the stock price go down. That's never something you want to hear. So what's my take after this deep dive? Bank7 is trying to chart a course through tricky waters, balancing growth, profitability, and external economic pressures. On one hand, management seems pretty solid, proactively tackling cyber threats and diversifying revenue streams through acquisitions. On the other, a lot of money is concentrated in the hands of relatively few borrowers. Their commercial real estate exposure is high, and rising salaries could hurt future profits. What's my opinion? It's hard to recommend the stock at this point. I think that this is a wait and see scenario. If you enjoyed this video, please subscribe, like, and comment. See you next time on Corporate Decoder.